Hi there. In this video, we'll explain how downsizing a home can affect inheritance tax planning and estate calculations.
In just the first 8 months of the tax year, HMRC collected £5.8 billion in inheritance tax. A large portion of that revenue is being pulled from ordinary homeowners who decide to sell their family house and move into a smaller property. Hello, and welcome to My Tax Accountant. We spend our days mapping out the UK's complex tax code to help families protect their hard-earned assets from avoidable penalties. To see how downsizing creates a liability, we look at this bar chart representing the Residence Nil Rate Band. It shields up to £175,000 of your property's value from inheritance tax, provided you leave the home to direct descendants. You work your whole life, pay off your mortgage, and decide to unlock some equity for a comfortable retirement. But by replacing a high-value property with a cheaper one, you inadvertently trigger a mechanism that strips away your tax protections and results in severe losses for your heirs. This line chart illustrates the core of the problem: fiscal drag. While UK house prices have climbed steeply upward since 2009, the main tax-free inheritance allowance has remained completely flat for over a decade. And if we expand the axes to look ahead to 2026 and 2027, you can see new asset blocks pile onto the estate total. With unspent pensions and capped business relief soon entering the taxable pot, thousands of average family estates are being pushed high above that frozen allowance line and straight into a 40% tax bracket. The specific downsizing tension occurs when you purchase a replacement property that costs less than the £175,000 threshold. Because your physical real estate value drops below the allowance cap, your estate appears to forfeit the unused portion of that tax-free relief. By simply trying to free up cash to live sensibly in your later years, you expose the remaining value of your estate to an avoidable 40% tax penalty. Meet Arthur. He is a widower who sold his £500,000 family home in 2021 to buy a £120,000 flat. He intends to leave the flat, along with his leftover cash savings from the sale, to his 2 children. This comparison chart reveals the mathematical trap he stepped into. The first bar shows his maximum £175,000 allowance. The second bar shows his new flat, which only fills up to £120,000. That leaves a £55,000 gap in his tax protection, meaning HMRC will now take a 40% cut straight out of the cash savings he intended to pass on. Some homeowners try to bypass this entirely by signing the deed of the expensive house over to their children while continuing to live there rent-free. HMRC classifies this as a gift with reservation of benefit. It instantly voids your capital gains uplift, and the property remains fully taxable within your estate when you die. Relying on informal gifting, or assuming that moving to a smaller house is a tax-neutral event, triggers severe tax liabilities without structured estate planning. The government did write a legal escape route into the tax code. It is called the Downsizing Edition, and it is designed to rescue the lost allowance for estates that disposed of a qualifying home after July 8, 2015. But HMRC does not apply this relief automatically. The executors of the estate must actively calculate the lost relievable amount and submit Form IHT 435 within exactly 2 years of the end of the month in which the homeowner passed away. For the addition to actually work, the estate must meet one core requirement. It must pass non-property assets, like Arthur's cash savings, of an equivalent value down to direct descendants. While the escape route exists, claiming it depends on completing specific mathematical steps and meeting a rigid deadline that demands proactive intervention from the executor. When the paperwork is filed correctly, we can see the final calculation for Arthur's estate. HMRC takes the £120,000 flat allowance and slots the £55,000 downsizing addition right on top of it. By utilizing the other assets he left to his children, Arthur's family successfully reclaims the full £175,000 tax relief, rescuing tens of thousands of pounds from the 40% tax rate. Correct application of the downsizing addition ensures the family's cash assets remain with Arthur's beneficiaries, rather than being lost to a 40% tax charge. Sitting back is no longer an option. The upcoming 2026 tax changes create a domino effect, placing unprecedented pressure on your family's estate allowances. You need to take proactive steps today to build your defense. That means meticulously preserving your old conveyancing records from past property sales, and formally updating your will to ensure your assets pass correctly to your direct descendants. Please note that tax law is highly complex and subject to constant change. This video is for general educational guidance and is not a substitute for tailored professional advice regarding your personal situation. If managing an estate or planning to downsize, contact our expert team at My Tax Accountant to build a strategy that protects your family's inheritance. In an era of aggressive tax code changes, a proactive professional strategy is the only reliable way to guarantee your financial security. Like and subscribe for more insights on protecting your assets.